Welcome, Meir, to the podcast. Just to introduce who you are to everyone, you worked as a trader for Deutsche Bank, an investment banking company which is listed on the New York Stock Exchange. Then you became the sales executive at an insurance company named Ali Dunbar, which was listed on the London Stock Exchange. Then you became the managing director for World Spreads, which was a huge online trading company. Then you became the managing director for an investment trading company called City Index in Tel Aviv, which is a subsidiary of
Correct.
StoneX Group, one of the world's largest trading providers with a net worth of over around £1.5 billion. Then you founded the Velenski Business Group. Did I miss anything? Or
No, you've actually covered most things there. I mean, there are a few odds and sods in between, but we don't want to bore everyone to tears.
well, how did you get into it?
Okay, so I started off in banking. My first job was in banking. I actually started off in a Japanese bank called Nomura. So I started working on then Japanese equities. And then from there, you move around in the city in the UK from bank to bank. And then due to religious reasons, I had to leave the city because they wanted me to work on Friday and Shabbos, the Jewish Sabbath. And that it infringed upon my religious beliefs. So I decided to set up my own business and go into a self-employed mode. So I started off working in a company called Eli Dunbar in Zurich. And then from there, set up Velenski Financial Advisors, Velenski Business Group. And then I got headhunted to move on to a company called World Spreads, then moved on to City Index, then went back to Velenski Business Group, which was still running at the time. It was running in parallel. And that's what I've been doing since.
Quite a journey.
Which is really, to be fair, I've very much moved on to the media. So I love the media, and there's a whole lot of knowledge that I would like to expose to clients or give over to potential traders, investments, business guys, people who need any type of business advice. I've been in across the board in business and in banking. So it's 30 years experience. And because there's so much experience there, and it's a wealth of experience, a lot of people come along and they don't give it over. So they keep it to themselves, and they might tell a friend here or there, but they don't give the mass public exposure to so many years of banking and business experience, which could be beneficial to any type of individual, whether located in the UK, the US, Europe, Canada. It's all very simple business advice. And based on the media, the viewers absolutely love it. And at the moment, it's all free. But I am setting up a mentorship program. So that's going to obviously be revenue driven. But at this stage, it's all free. Yeah.
You say expose.
Not expose, the wrong word. To give over.
Okay.
To release the information, to give over the information, not expose, to give over the information to the Joe public.
So and just to explain to everyone, you do a daily show where you talk to the way you put on YouTube, Instagram, quite a lot of social media places talking about the daily market.
That's correct. So we've got three media channels. Well, I've actually got more media channels, but the three main ones are YouTube, which is a market report on a daily basis. There are some days when I don't do it because I could be either occupied or just can't do it physically. Instagram, TikTok, LinkedIn, and Twitter. Twitter is probably the weakest one of my media outlets. In terms of I don't invest enough time in it, but the other ones are pretty strong. The strongest being the Instagram. It's got the most amount of views and the most amount of people following on a daily basis. It's very popular. It's very much a summary of macro events. So it's not so much of an analysis of where the pound dollar is going to go, or Aussie Canadian dollar, or crypto, or Tesla shares, or Amazon, or BP, or Tesco's. It's not talking technical, it's talking fundamentals, which is the macro picture, and to empower the individual viewer with the knowledge that they either know, they don't know, or they haven't got the time to research, and it's just condensed very quickly into a 7-8 minute broadcast.
So let's jump right into it, into what's happening in the market. Are we in a recession?
Right. Okay. So there's two measures of recession. There's the official measure, which is 2 negative GDP quarters. GDP for the viewers is gross domestic product, or in simple words, is the business of the UK making money, or is the business of the UK as a business, is the UK making money, or are they losing money? So if they're making money, they have positive GDP, they're not officially in a recession. If UK Limited is losing money, then the business is going down and they're in a recession. So if we take the word recession and we just translate that into an actual PLC or limited company or whatever type of small business, you just look at your books and you say, wow, you know what, Ellie, you've made a load of money in the last quarter. You're growing. Great. I would invest in you because you are a growing entity. But if you come along and Ellie is the UK enterprise and say, listen, man, I'm actually losing money 2 quarters. I say, really? I said, okay, you're a nice guy, but come back to me when you're making money. And the UK at the moment is teetering on negative GDP, negative growth, teetering. So the official recession, according to the numbers issued by the government, are not there yet. However,
by what you're talking about there,
you're
talking about that there's growth, that there's negative growth, positive growth, or you're talking about like final whether they're making money or losing money?
Right. So there is the GDP at the moment in the UK is just positive by 0.01. So it's just above just above the zero and obviously positive growth. By being positive, it shows that the UK is still above recession. It's not quite there yet. However, the feel on the street, when you talk to the businessman or the man in the street, there's a feel of negativity, concern, worry, interest rates, business has slowed down, there's not the turnover, and therefore the man in the street is feeling the bite before the official numbers would reflect that particular downturn.
So just to go over, there's 2 types of recessions, right?
Well, there's one type of recession which is official. Is the UK producing negative GDP? That's official recession.
Yeah.
However, there is real feel recession when the businessman feels a recession on the street. He doesn't feel confident. There's no business or business has slowed down. That is a hidden recession. That's not reported by the government. So they're not going to report, for example, from Manchester, 9 out of 10 businesses aren't doing well. They don't feel good. They're not producing the same money. Their business slowed down. So they feel there's a recession. But the government comes along and says, what are you talking about? Our numbers are great. Well, that might be so. But the man in the street who's selling towels or shoes or shirts is not seeing the turnover. Therefore, he feels there's a recession, but the official number could still be positive. So there's one official number, one unofficial feeling of the man in the street. Unofficially, we are in recession. Unofficially.
It's quite scary to think that.
It is quite scary to think that, but when the recession will come around on several factors. Number one, when there is a tightening of liquidity. Liquidity is quite simple. You've now got 100 quid in your pocket, 100 pounds in your pocket for your international viewers. You've got 100 pounds in your pocket, and now take out 30 pounds towards interest costs. You've just reduced your liquidity by 30 pounds, where 2 years ago, I would have taken £2 out of your pocket. So you'd have 98 pounds available. Now you've only got 70 pounds available. That is a contraction in liquidity, contraction of cash flow, contraction of available money you have to spend. So the less money you have to spend, I'm talking about the general public, then they feel there is a press on liquidity, cash flow, and therefore that causes a recession. The other factor of recession, which is the most dangerous part, is rising unemployment. However, at this moment in time, we don't have rising unemployment because there's a massive shortage of labor due to the pandemic and due to other factors of working from home and a change in the social economic culture within the UK and within Europe and America. So it's not just only pertinent to the UK, it's globally there's a shortage of labor.
So although there's a rise in inflation, unemployment is actually going down, but at the same time, it doesn't make so much of a difference about unemployment.
Correct. So the real inflation has gone up because of supply-driven issues from the pandemic. That was the original starting point of inflation. Actually, excuse me, I go back even further. The original starting point of this cycle of inflation was the looseness of money from 2009-10 all the way through to now, where interest rates were zero. And as a result of being zero, people borrowed money, people spent more money, and therefore there was an atmosphere of money is cheap, let's spend, whether invest or spend, okay? Then came the pandemic, and then there was more money poured into Joe Public. In Europe, in America, in England, people just got money for nothing. On the, what was the program called in the UK? Can't remember what it was called. And people got money paid every month, okay? Got the salary paid for staying at home because of COVID-19. However, what COVID-19 did is it broke the supply chain. And once the lockdown was released in the UK and in Western Europe and in the US, people were released from their lockdown. They had all this money accumulated in their bank accounts. What did they go and do? They went mad. They went and bought goods. They didn't just buy simple goods. They went and bought all the expensive goods. The D&Gs, the Louis Vuitton, the Rolex watches, the Hublots, the cars. They went mad spending all this money that they're not used to because there were no pubs, no restaurants, no holidays, no vacations, nowhere to spend the money. So they accumulated all this money. Mortgage rates were 0 or 1%. So the mortgage was costing nothing. They had huge amounts of money and they went out to buy limited goods. There were no goods on the shelves because of the pandemic. Pandemic caused a break in the supply chain. You've got a break in the supply chain and massive demand as a result of the lockdown being released. All the public come out and start buying goods. There's no supply. The factories in China and in the Western world were running at maybe 20 or 30%, if that. As a result of that, there's no supply, natural economic states, low supply, high demand, prices rise. So the prices began to rise. Then came the Ukraine-Russian war. And that caused further pressure on commodities and oil. However, the West blamed Putin for inflation. Putin has nothing to do with inflation. Inflation was already there. The ingredients were there from the 2008 printing of money cycle, quantitative easing, the pandemic, and this flow of money into the world. That flow of money filled up everyone's bank accounts. And from that moment onwards, once they released, they went out to buy goods. There's no supply, you have inflation. Inflation is here now for longer term. It's not going to be here for less than 3 to 4 years minimum at these levels, due to all types of factors. High energy prices, there's a problem in the food supply, there's a change of social demand. Prices are not being lowered from manufacturing level to retail, so the manufacturer is not passing on the reduction in price down to the retailer. And the idea of interest rates is that the higher the interest rates are, then that will taper the demand or reduce the demand of the people to buy goods because they're paying all their money on credit cards, loans, and mortgages.
Okay, brilliant. Just moving on to the next point. What's up with the banking crisis? I heard you talk quite a lot about the banking crisis. What's up with that?
Okay. So it's not so much in the UK. It's going to be in the US starting off. It's starting off effectively because the regional banks don't have enough money. And the problem is at the moment is that they had huge amounts of money up until 2021, and they invested their surplus money in government bonds when the government bonds were effectively the yields or the return on the money was low. So they thought, well, it's safe to put into government bonds. As a result of that, the price of government bonds has gone down and the value of their investments has gone down. And therefore, that's caused a liquidity crisis on the banks. Now, the other crisis, which is now brewing as far as the banks are concerned, and this is mainly in the US, so we're going to go away from the UK, just talk about the US for a little bit, is commercial property. Commercial property in the US is in a shocking state. It's in a bad way in the UK, but it's not yet in a shocking state. The US, certain cities, due to crime and due to drugs, there's whole areas of the city being abandoned. As a result of those areas being abandoned, the businesses have walked away from the business all gone bust. And they've been let, and the banks now, the regional banks, have been left with huge debts with no one to pay those debts. So the banks are going to have to write off that debt. Now, where's the money? If they write off $558 million or $1.4 trillion, where's that money going to come from? In comes the Fed, the central bank, turns on the printing machine, off we go again, starts printing a load of money to bail out the banks as a result of the commercial property crash. That is going to happen. There's going to be another banking crisis. In the UK, slightly different. In the UK, you've got the big banks that loaned money.
Just a quick point about that. You mentioned that one of the big reason is because a lot of cities are becoming abandoned. Therefore, the banks have lost all the money that people have borrowed and put into that city. Is that more recently? Has crime gone up more recently? Has cities been more abandoned recently? Isn't this over the years generally? Or
excellent question. Excellent questions. There's a drug called fentanyl, which is a pain-killing drug, and it's turned whole sectors of the city into no-go areas or drug areas, and the takers of this painkiller become addicted and they become zombies. They just stand in the street as if nothing's happening. So there's been an increase in drug taking. There's been lack of input by the Biden administration to tackle these crime areas. Why? Because he's taken money away from the police. He's reduced police expenditure and therefore, he's reduced police funding, and therefore the police have less money to allocate resources to patrol and police these areas. So it's fundamentally a drug problem leading to crime problem, lack of funding by the police. As a result, whole areas of the West Coast, the East Coast are abandoned, and those properties now, those companies have gone bust. In addition to that, there's some very big companies, irrespective of crime and drugs, have gone bust, like Hertz, like Victoria's Secrets, like some Lordstown. There's lots of companies have gone bust purely because economic activity has dropped so much. They don't make the money anymore like they used to, and therefore they've gone into Chapter 11. That's in the US.
yes,
UK
why don't they just ban the drug?
Right. So they don't to ban the drugs. I wish that was a very simple thing to do. It's like blocking the border at Mexico so cocaine and heroin doesn't come in. But where these drug dealers get the drugs in one way or another through smuggling. So it's a very sought after drug, and it's a horrendous drug. And the pharmaceutical companies are the ones really, if they stop producing it, then I think that would solve the problem. But there's too much money involved for the farmers to stop, for the pharmaceutical companies to stop producing it. That's in the States. In the UK, slightly different. The UK, we haven't got the same level of drug and violent crime like they have in the US. So shops are not being ransacked and raided. However, the commercial property sector in the UK and the residential sector in the UK is up for an absolute hammering. The residential sector is up for a hammering because fixed rates are going to move. Those people on fixed rates, the 2-year fixed or 5-year fixed rate mortgages, are now coming to an end from the 2018 period. So anyone who's changing their mortgage now is going to see a 200 to 300% increase in their mortgage payments. Now, people who've been used to paying £900 a month or £1,000 a month for their mortgage are now going to be paying £3,000 a month. That's a hell of a lot of money to take out of someone's monthly salary to start paying a mortgage. So already in the UK, what you've got is an immediate drop of 10% in residential property, and that's before you even start negotiating. So by the time you finish negotiating, sorry?
What do you mean 10%?
Okay, so the valuers are down valuing properties by at least 10%. So say, for example, you go to buy a house now for £500,000. You've agreed £500,000. You've agreed it. That's what you all agreed. The valuer will value it at 450. So there's a 10% down on the valuation. But the house might have been marketed at 550 or 570. You come along and you say, listen, I'm not going to give you 570. I'll give you 500. There's no buyers out there. There's no buyers that are willing to pay that price and support a mortgage of 6% or 6.5%. It's too expensive. Therefore, the buyers have dried up. The sellers are getting a bit desperate because they can't afford the properties. Therefore, you're having a downtrend in overall prices in the UK, commercial and residential.
Will this become a crash?
Wow, very good question. So at the moment, we've still got at least another 100 basis points to go up in the UK. 100 basis points is 1%, at least 1% to go up in the UK. And you could not necessarily have a crash, but you could see 25% drop in properties in the UK.
Oh, that's a lot.
Yeah, that's a lot, yeah. So you could say that. So anyone who bought a house in the last 2 years or 3 years could see all of their growth wiped off overnight, which means that the banks are fine with it. The banks are fine as long as you pay the mortgage. However, the minute you stop paying the mortgage, it's all over.
So the people who are signing their new fixed rate contracts, they're going to be suffering, and therefore everyone's going to be suffering. And then buyers and sellers.
They're going to be suffering. The people who are homeowners that have to take out a new fixed rate are going to be in trouble. They're going to be in trouble.
What would you advise for people to do who are in the property market in the UK?
Well, first of all, those people who are looking to buy property, I would suggest you hold off. Just wait, because you probably buy the same property in a 12 months time for 20% cheaper upwards. Those people who already got a property and they're looking to fix their rates, I don't know. I haven't got any solid advice, but what is the best rate available? Take out a 5-year fixed, whatever rate is, and those are talking about 6.5, 6.6%. So that's really expensive. Really expensive.
People should take a fixed rate out now.
Well, if they take out a variable rate and rates continue rising, then they could end up being in trouble. Yeah. So it depends on the individual circumstances.
Yeah. Oh, wow.
That's right. That's right. So it's based on the individual circumstances.
Oh, wow. Okay. So it doesn't sound good. It doesn't sound too good in that sense.
No, the property market is definitely in for a downturn. It's the sellers might not sell it, they might hold on. However, the buy-to-lets, which is the commercial property side, where people buy property to let out, they're now seeing their rates go up to 8%, and the return on the property is 3%. They're saying, well, what's the point? So they're now going to have to sell the property because it's not commercially viable.
Oh, wow. And then everyone's going to probably, a lot of people are going to leave the property market and go elsewhere.
Correct.
Oh, wow. Okay.
Correct.
It's
people at the moment want their money back.
Anyway, so moving on.
Sorry?
Not positive future.
Well, it is positive because everything goes in cycles. So in the near future, it looks like a downturn, but that would be an opportunity to get onto the bandwagon as rates peak and come down. You'll be able to make some money in the future, but not at the moment. At the moment, it's going to be pretty difficult.
Can you take advantage of the property market going down by investing whilst it's down? And when it's, as long as you know how to do it well, they take advantage of it going down.
But if you've got enough money where you can go and negotiate a deal, so if you've got several 100,000 where you can actually walk into a deal and say, listen, the property is now worth 500,000, right? And the person is distressed, or their property is in distressed state where the owner needs to get rid of it. That's what's going to happen. That's where the deals are going to be done. You're going to come along and say 500,000. I think this property is worth valued 400. You give him 400,000, you've got property at a good price. So it's distressed sellers will end up lowering their price.
Okay. Now moving on to the stock market. What's happening with the stock market? What's the forecast there? What's everything there?
Okay, so there is a lot of momentum upwards on the stock market. It's talking about the US, Europe, and the UK. So the momentum is north, going up. UK is slightly different to the US because the UK does not have a technology sector such as the US does. So the UK is very more defensive built. So in times of recession, the UK stock market would be a good investment. In times of growth, the US market is a good investment. So the US is being pulled up by the tech sector, AI, ChatGPT. That is the new phase. So all the tech sector, which is the Amazons, the Metas, the Facebooks, as I mentioned, Teslas, Netflix, all the technology is being pulled north by AI and ChatGPT and the semiconductors. So the forecast in the near future till the end of the year, you're probably going to have a rising market in the US and in Germany. However, fundamentally, it should not be there. Fundamentally, this market should be down, but it's disregarding all of the negative facts in the marketplace: high interest rates, high inflation, businesses going bust, cycles slowing, recession, property prices dropping. It's ignoring that, and it's just driving itself forward, probably to the end of the year. Come the end of the year, November, December, then it'll slow down. In January 24, you probably start seeing some major correction on the stock markets. Again, talking about at least 30%.
Why is the stock market going up when, as you're saying, it should probably go down?
Right. So the stock market's going up purely being pulled by the tech sector. This craziness, this frenzy, this FOMO, the fear of missing out on the tech sector is pulling up the market. Now, the NASDAQ is made up of 100 technical tech stocks. Two of them make up 25% of the NASDAQ: Microsoft and Apple.
Two out of 100 companies make up 25%.
Correct. The 50% of the NASDAQ don't make any money. So the NASDAQ is a weird index. It's pulled up by a few profitable companies. Most technology stocks are down in the dumps. However, the mega stocks are pulling up the NASDAQ. Why is it going up? There's several reasons. Number one, there's an election next year. So deep state in the States, we're not going to allow the stock market to fall. There is a understanding, let's call it, not a conspiracy, an understanding between the Fed and Wall Street to push prices higher. By pushing prices higher, they're giving an overall feeling to the general public that things are good because their pension schemes, 401ks, are moving up, prices are moving up, their investments are moving up. So the Fed is trying to manipulate a situation where there's a good feel factor in the US. The US is the major engine of stock markets. If the US goes up, everyone else goes up. Irrespective of their local circumstances, everyone follows the US. So the US is going higher because it is being slightly manipulated, or a lot manipulated, by Wall Street. They've got several reasons. One, they want stocks to go higher because they're holding the stocks. Therefore, by them holding the stocks and the stocks go higher, their profitability rises on their asset balance sheet, makes them more valuable, makes it easier for them to borrow money and lend money. So everything's rosy. However, it's not rosy. But for this year, they've got to be in their bonnet. They want the market to go up. There's no point fighting it. It's going to continue rising. Therefore, my opinion and recommendations on my daily channel are: don't go selling the market today. Don't go start taking action today. I'm giving it a macro picture. Over the next 12 to 18 months, there'll be a significant drop in stock markets as more and more companies go bust, as unemployment rises, and as inflation remains absolute solid. Interest rates will not come down. That's the overall view. Brings me on to Bitcoin, which is an interesting one. Bitcoin is seen by some investors as a safe haven. So as the banking crisis, which will formulate throughout the end of the year, end of the summer, that could bring down the stock market because the banks are a major part of the indices.
So are you saying, just on the first point about the stock exchange in America, that the government is working together with Wall Street to ensure that they win the next election by putting up the stock prices?
Yes, they won't necessarily think they want to win the next election, whatever the case may be, and keep Trump out or the Republicans out of office. That is, there is an understanding, for want of a better word, between the government and the Wall Street. Wall Street want the present government in power. It's stable, it's quiet, don't make too much noise. Where Trump was erratic, was always up and down, massive. They don't want that. So they are behind Biden. They want Biden to. So then one of the vehicles that Biden needs is a strong stock market. If the stock market collapses before the next election, that has a major impact on voters turnout and voters' views who they're going to vote for, because they'll see their assets drop in value. They say, well, he's trash. Let's get rid of him. Let's vote for someone else. So it's in Biden's interest to keep the stock market high, so he can say, look what we've done. We've built the stock market high. He hasn't done anything. The guy's incapable of doing anything, but that's my political view anyhow.
Assuming that was the Wall Street are working together, or they are putting up the pricing, if they weren't interfering with it, would the stock market collapse before the elections?
Very good question. Probably be down now 25%.
From what it is now, they're hyperinflating at 25%.
At least. So if it wasn't an election year, or was a normal economic cycle without interference by the 23 biggest banks in America and the global market makers in the world who are manipulating the prices, because I've been there. I've been a market maker at the top level. They can manipulate prices. They can buy stocks and shares, and they just pump it up, and then the general public think it's going up. They go and buy it, and then the big banks will sell the shares, and the general public is left with shares that are high, and the banks have got out now, and they buy back lower on. So the big banks are the ones that make the money by screwing general public. So my daily media podcast is there trying to help the general public to identify opportunities and not get taken in by these big mega banks who are obviously only looking to make profit at the bottom line. They don't care about you or I, which is understandable. Why should they?
So are there any opportunities right now in the stock market if it's being put up 25%?
Okay, so for example, the Russell 2000, which is the US index small business cap index, is a good opportunity. That is undervalued, and that looks like it's got at least another 10% to move up. So that's an opportunity to buy the Russell 2000 index. Otherwise, I don't see the particular opportunities of these valuations. I think Tesla's overvalued. I think Facebook is overvalued, Meta. I think Amazon's overvalued, Apple's overvalued. So on fundamentals, I would not be buying these shares. In addition to that, one of the number one investor mogul in the world is a guy called Warren Buffett of Berkshire Hathaway. And he's got an index called the Buffett Index, Risk Index, and that is showing overvaluations and showing that correction, which is a downward trend, is on the cards in the near future.
But Berkshire Hathaway, though, has around, I think it's around 45% of their portfolio in Apple.
That's right. So Apple, they see as a solid stock, 100%. They don't see, even if it drops 10%, as far as Berkshire Hathaway is concerned, that's not a big deal. They don't see any fundamentally wrong with Apple. I see that Apple is overpriced as a company. So I'm not saying don't buy Apple ever, and if it goes down, don't buy it. The opposite. If it drops down certain level to say now it's 182, 188, if it drops down to 150, 140, it could look like an attractive buy at that level. So I don't say don't buy the shares, but not at these levels. He's not buying Apple at this level. He bought Apple at 118, 122. So he bought it really cheap.
You mentioned about like a few tech companies, whether it's Tesla, whether it's Apple, all these different tech companies, which is overvalued. Are all tech companies, or most tech companies by design, overvalued because the general public believe in them, and therefore the price-to-earning ratio is much different to a normal company?
No. 90% of tech companies at the moment are not overvalued because they took a hammering in 2022. Yeah. But the mega companies, the big fangs, the Facebooks, Apples, Amazons, Netflix, Googles, they are the ones that are making the headlines. So in order to get a tech company that's good value, you've got to look at how much it's come off. And some of them have come off significantly since last year, not recovered, and they could have intrinsic value. But the big ones that take the headlines is the Facebooks, the Apples, the Amazon, the Netflix, the Googles, etc.
So all those big ones are overvalued?
In my opinion, yes. Well overvalued. NVIDIA, for example, a semiconductor chip manufacturer, is 200 times earnings.
200?
So in other words, 200.
Oh, wow.
So it's going to have to make 200 times its present earnings to justify its share value.
That's very high. What would you usually do as when you do this sort of thing? What's your usual maximum? I presume each time it's different.
18,
18.
18.
18. Oh wow. So even that sounds quite high.
It is originally, back in the original days, to be 10 or 12. 18 because of the tech sector and the FOMO and the frenzy. So I've upped it to 18. But going to 50, 60, 100, 200, sorry, that's just, I can't buy into that.
You're brilliant. And just
Apple's only 40. Apple's only 40 times.
but yours is 18, so there's a big difference.
Still too high, yeah.
So you wouldn't invest in Apple in these sort of areas at
Not this level. Neither does Warren Buffett invest in Apple at this level.
Okay. So has he not invested in Apple for like a year or two so right now?
So he bought Apple in the last year, and the market was down.
Yeah.
He bought some in November, December last year, about 128. So he's okay, yeah.
Okay, brilliant. Moving on to the next point. What's just as a general point, what's your economic forecast for the next 12 months?
Economic forecast for the next 12 months. Okay, so there'll probably be continuous full employment. There'll be slightly rising unemployment.
Where is this, by the way? Is this in the UK, USA? Or
in the UK, in the UK. The US will come to us. This is UK now centric. There'll be a property drop in the UK over the next 12 months. People will get into difficulties, and the UK government will have to come to some arrangement with the banks to stop repossessions, because once the banks repossess, then it can kiss goodbye to the property market. So there is a problem there. As long as there's full employment, then there's hope. If unemployment rises, which I think it will slightly rise over the next 12 months and then higher in the next 24 months, then you're going to have a problem. I think geopolitically, there's a problem on the market between Iran and Israel. I think there's going to be a war between Iran and Israel geopolitically. So that's an issue. China is in a recession. It's going to go into a deeper recession over the next 12 months, even though they've got positive GDP. Their businesses production is just dropping through the floor. They've got a problem. US probably have rising unemployment over the next 12 months. At the moment in the US, the numbers are manipulated. So there's a lot of people who are unemployed, but not on the register, because the way they calculate the numbers is they exclude long-term unemployment. So long-term unemployment is not considered unemployment. That's why I keep having all these as if jobs created. It's not true. More businesses in the US are going to go bust. The commercial property sector is going to send commercial property sinking and could impact retail if unemployment rises. As soon as unemployment rises in the US, you get credit cards and car loans will default, and then mortgages.
Oh wow, that's
so it's going to be recession. Going to be recession in the next 12, 18 months.
Worldwide.
Europe's already in one. Germany's in a recession already. Official.
That's an official recession.
In Germany,
what does that mean once it's in an official recession?
It means nothing. Just means that is it a country to invest in? I mean, the Bundesbank has 650 billion euros of debt that's got to pay interest on. It's got no money. So would the Bundesbank go bust, which is the central bank of Germany? Possibly, but doubt it. Deutsche Bank's in trouble. So Germany overall is in trouble, yet the stock market's going up. So we've got a situation where everyone's driving towards the end of the cliff and they're just following the car in front of them. Yeah, it's moving. Let's just follow that car. Let's just keep on moving. Boom. Oh, it's gone. End of the cliff. And that's what's going to happen. So we're going to recession.
A lot of people are going to lose their money in the stock market.
In the stock market, the value of their assets will go down. They'll only lose their money if they close out their position or they sell their shares. But there will be a drop in valuation, yes.
Okay. Thanks so much.